Here's a number that should stop you cold. 71%. That's how much NIO's deliveries just exploded year over year. And right now, thousands of retail investors are looking at that figure and screaming that this is the bottom, the turnaround, the moment to back the truck up. But what if I told you that same 71% number is hiding something underneath it? Something so contradictory that once you see it, you will never look at this delivery report the same way again. Welcome back to Calvin Mateo, the channel where we bypass the hype and dig into what the numbers are actually telling us. If you love data-grounded breakdowns like this one, do me one quick favor and hit that subscribe button right now, because this is the exact kind of analysis you do not want to miss. If you ask the average retail investor about NIO stock, they will likely tell you one of two things. Either they will say the company is a massive wealth destroyer that has trapped their capital, or they will claim that the latest 71% surge in deliveries is the ultimate signal to jump in. But both of these obvious conclusions are completely missing the real mechanics at play. Today is August 10th, 2026, and we are looking at NIO stock trading at $4.73. At first glance, it looks like a straightforward growth story, but one number later on makes that conclusion far harder to defend. There is a deep structural contradiction happening between what you see on the surface and what is actually happening to this company's capital. In this video, we are going to dissect a real institutional ledger, look at a massive strategic windfall that retail is completely misinterpreting, and build a balanced, realistic trade setup for the weeks ahead. So the question is, could this be the most misunderstood stock on the market right now? Let's find out. To see why the standard bullish and bearish narratives are both failing right now, we have to look at the unique holding pattern this company has built for itself. NIO is currently suspended in what I call the equilibrium trap. The business is caught in a highly coiled holding pattern where every positive catalyst is immediately met with an equal and opposite capital friction. Technically, the stock is completely flat, consolidating near the absolute bottom of its multi-year range. Operationally, its rapid brand scaling is locked in a direct war with massive infrastructure expenditures. And when you look at market sentiment, retail investors are completely surrendering, while institutional smart money is quietly accumulating. It is a state of perfect contradiction. But here is the thing you need to understand. Could a stock this tightly wound actually stay frozen forever? Because before you assume this gridlock will last, you need to know that the options market is right now building a pressure cooker that is going to force a breakout very soon. But before we look at that options ceiling, we need to map out exactly where the stock is currently trapped on the charts. If we look closely at the charts, the near-term technical picture is a frustrating exercise in consolidation. Squeezed into a tight channel near its annual floor of $4.37, NIO closed the week at $4.73, up a modest 2.8% on Friday. But do not let that minor daily gain fool you. The stock is still trading heavily below its 50-day simple moving average, which is sitting between $5.01 and $5.13, and its 200-day simple moving average at $5.36. More importantly, trading volume is currently 34% below average. This tells us that the general market has completely lost interest, leaving the Relative Strength Index, or RSI, sitting at a completely neutral 49.88. In other words, there is zero momentum here. The stock is coiled, but it has no directional trend. So could this dead quiet chart be the calm right before an explosive move? Keep that question in your mind. That sounds like a boring technical setup until you look at what is happening underneath in the derivatives market. While the equity market is quiet, the options chain expiring on August 14th is telling a completely different story. Derivative traders are setting up an incredibly tight boundary for next week. On the put side, there is a massive open interest wall sitting at the $4.50 strike with 3,867 contracts. This acts as an immediate, heavy technical floor. Market makers will defend this level aggressively because if it breaks, they are forced to short the underlying stock to hedge their positions. But on the call side, look at the resistance. There is an immense wall concentrated at $5 with 5,886 contracts, followed by $5.50 with another 6,536 contracts. That is over 12,000 combined contracts, acting as an absolute psychological and technical ceiling. This means market makers have NIO pinned like a butterfly under glass. So could this be the tightest squeeze setup we have seen on this stock all year? The numbers say yes. But while market makers want to keep the stock in a box, NIO's real-world delivery data is trying to force a major re-rating. On August 1st, NIO reported its July deliveries, and at first glance the headline was spectacular: 35,934 vehicles delivered, representing a stellar 71% increase year over year. Year to date, they are up 68%, having shipped 227,057 vehicles. Even the brand breakdown looks highly diversified, with their premium NIO brand delivering 20,008 units, the family-focused Onivo brand bringing in 10,155, and their compact Firefly line delivering 5,771. But here is where the story starts to get more complicated. While that year-over-year number is beautiful, deliveries actually declined sequentially by 11.5% compared to June's peak of over 40,000 vehicles. This brings us to our first moment of real analytical uncertainty. Is this sequential decline just normal summer seasonality, or is the initial demand for the new Onvio and Firefly models already starting to hit a wall in China's brutally crowded market? Frankly, we do not have enough consumer data yet to be certain, and anyone telling you otherwise is just guessing. But deliveries are not the only place where NIO is seeing massive volatile numbers. There is a hidden catalyst on their balance sheet that almost nobody is talking about. On July 26th, China's largest memory chip maker, Changshin Memory Technologies, or CXMT, went public on Shanghai's Star Market. Years ago, NIO made a quiet, strategic pre-IPO investment of $23 million, buying over 18 million shares at just 8.66 yuan per share. On its debut, CXMT stock skyrocketed over 500%, closing its first session around 54 yuan. Suddenly, NIO's stake is worth $132 million. That is a paper profit of over $100 million. But before you get too bullish, there is another layer to this. This profit represents a massive balance sheet win, but those shares are locked up for 18 months. This brings us to our second moment of analytical uncertainty. Does an illiquid paper gain actually help a company fund its daily operations, or is it a non-operating distraction that retail investors are heavily overvaluing? While it secures their premium LPDDR5X automotive memory chip supply chain, it provides exactly zero immediate cash flow to fund their actual cash burn. So could this headline-grabbing windfall be almost meaningless for the thing that actually matters? That is the question you have to ask. And cash flow is everything, especially when you look at the fundamental battle between NIO's bull case and its structural risks. To be fair, the fundamental bull case is stronger than it has been in years. First, NIO is finally turning the margin corner. In its last reported quarter, vehicle margin rose to 18.8%, up from just 10.2% last year, allowing them to post a non-GAAP adjusted operating profit of 66.8 million yuan. Second, their premium execution is highly resilient. Their flagship ES8 SUV has achieved 130,000 cumulative deliveries within just 305 days of launch, maintaining a premium transaction price of roughly $64,000. And third, their sub-brands are widening their addressable market, capturing over 44% of July's delivery volume. Backed by a massive $7 billion cash buffer, NIO has built a formidable runway. That sounds like an incredibly robust growth story until you look at what is happening underneath the operational hood. If we dig deeper into the bear case, the structural headwinds are immense. First, the domestic Chinese price war is relentless. Competitors like BYD, Li Auto, and Xiaomi are discounting constantly, and NIO's Onvio brand recently faced severe consumer backlash over surprise discounts. Second, despite non-GAAP adjusted profits, NIO is still bleeding on a GAAP basis, posting a net loss of 332 million yuan in the first quarter, following a devastating 14.9 billion yuan net loss in 2025. Third, we have what I call the swap station capital trap. NIO is aggressively operating nearly 4,000 battery swap stations, with plans to build 1,000 more this year. While this is a brilliant competitive moat, the sheer capital expenditure required to maintain this network could dry up their free cash flow for years. And finally, the persistent geopolitical hangover of being placed on the Pentagon's Section 1260H listing acts as a constant dampener on international capital. So could the very moat that makes NIO special also be the anchor that drowns it? That is the tension at the heart of this whole story. To visualize how these two cases collide, we have to look at how NIO's capital is actually distributed. This is the core operational red flag. NIO is fighting a dual-front war of expansion. They have a massive $7 billion cash buffer, but look at where that capital has to go. On one side, they must fund the immense marketing and operational complexity of running 3 separate brands simultaneously. On the other side, they are building out an incredibly capital-intensive physical infrastructure network across China. This dual drain is why high vehicle margins are immediately consumed, keeping GAAP profitability completely out of reach. It is a highly capital-intensive treadmill, and the faster they run, the more they burn. And this exact capital intensity trap is what has created a massive historic divide between retail and institutional sentiment. This is one of the most fascinating sentiment divergences in the market today. On one hand, you have massive retail despair. The average cost basis for retail investors sitting in popular forums is a staggering $47.79. Read that again, $47.79 against a stock trading under $5. After a multi-year 89% drawdown, retail is completely throwing in the towel. But on the other side of the spectrum, the institutional smart money is aggressively loading up, now controlling 48.55% of NIO's outstanding float. So here is the question that should keep you up at night. While retail surrenders at historical lows, why are global institutions quietly taking control of the board? What do they see that the crowd does not? If we look at the actual regulatory ledger, we can see exactly who is buying and who is selling. The institutional activity here is eye-opening. Look at these numbers. UBS Asset Management increased its position by an astronomical 3,966.7%. Bank of America expanded its holdings by 99%, now owning over 14 million shares. Renaissance Technologies, the legendary quant fund, boosted its position by 70.2%. Meanwhile, HSBC was one of the few major sellers, slashing its position by 68.7%. At the same time, short sellers are in full retreat. Short interest has plummeted to a 32-month low of just 5.22% of the float. With a days to cover ratio of 5.2 days, the immediate downward selling pressure has completely dried up. So could this be the quiet setup right before the crowd wakes up? The ledger is certainly leaning that way. So with the smart money buying and shorts covering, what does Wall Street think this stock is actually worth? Wall Street's analyst consensus is deeply split, reflecting the highly coiled nature of the stock. On the bullish end, we have Zacks Research upgrading NIO to a strong buy, forecasting full GAAP profitability by 2027. Goldman Sachs is sitting with a buy rating and a $7 price target. But then you look at the middle of the spectrum. Bank of America and Bernstein are much more cautious, maintaining neutral ratings with targets of $6.80 and $6 respectively. On the far bearish side, Weiss Ratings remains a firm sell. The overall stance is a highly divided wait-and-see hold. So could the analyst be this split for a reason, or is one side about to be spectacularly wrong? With the analysts so deeply split, how do we navigate the next 2 weeks as traders? If you are trading this stock, there are clear lines in the sand. Over the next 2 weeks, we need to monitor China's weekly retail sales to gauge the NIO L80 ramp-up, followed by any macro EV policy updates from Beijing. But the ultimate catalyst is the September 1st second quarter earnings report. Here are your invalidation levels. If NIO closes below $4.37, the technical floor is broken and the turnaround thesis is dead. On the flip side, to confirm a true bullish trend reversal, the stock must break and hold above the 200-day moving average of $5.36. Until then, it is just noise. This setup gives us 3 very distinct pathways following the September earnings call. As we head into September, we can map out 3 logical scenarios. Scenario 1 is the bullish turnaround. NIO holds its $4.50 option support floor, reports a narrowed earnings loss, breaks past the $5 technical resistance, and heads toward Goldman's $7 target. Scenario 2 is the endless grind. The stock remains pinned between $4.40 and $5, tightly bound by options. Investors sit on their hands, refusing to re-rate the company until full GAAP profitability is proven. And scenario 3 is the value trap. Weekly sales weaken, price wars compress margins further, the stock breaches the $4.37 support floor and slides toward $4 as capitulation intensifies. So which pathway wins? That single earnings report on September 1st may decide everything. And that brings us to the one question investors actually care about. What is the final objective bottom line? The final verdict is that NIO is walking an incredibly thin tightrope. The current setup is highly coiled, trapped between massive retail despair and aggressive institutional accumulation. Because of this, we have to land on a hold. We need to let the September 1st earnings report definitively answer the only question that matters: is their operational scale finally overcoming their structural capital burn? Until we see those audited margins, chasing the stock is a high-risk gamble. Let the smart money build the floor, wait for the earnings clarity, and protect your capital. Now, before we wrap up, I need to be crystal clear with you. Everything you have heard in this video is for informational and educational purposes only. It is not financial advice, and I am not your financial advisor. I do not know your personal situation, your risk tolerance, or your goals. Every single number and target discussed here should be independently verified, and you should always do your own research and consult a licensed professional before making any investment decision. Markets are risky, and you are the only person responsible for your own capital. With that said, here is my thoughtful question for you, and I genuinely want to know: if the institutions are buying while retail is capitulating at a $47 cost basis, who do you think is right this time, the smart money or the crowd? Drop your answer in the comments below, because I read every single one and the best takes always spark the next video. If this breakdown gave you a clearer picture of what is really happening with NIO, smash that like button, and if you are not subscribed yet, hit that subscribe button so you never miss the next deep dive. This has been Calvin Mateo. I will see you in the next one.